Grab a cup of coffee. In today's video, we're going to discuss Bank of Canada's latest decision on the interest rates, the factors involved in making that decision, the direction of the Canadian economy, and what the future might hold. Let's get started. So looking at the decision made by Bank of Canada just this last week, this is the third consecutive rate pause after raising, the benchmark rate to about 5% over the past year and a half. Everyone was expecting that decision. Everyone was expecting Bank of Canada to hold that rate of interest there. But if we quickly look back at the timeline of these, interest rates hikes, there's an interesting story there. Let's have a look at this. So if we have a look, back in March 2022, the rate of interest in Canada was about 0.5%. That was the Bank of Canada interest rate. Then slowly over time, they took it over about to 4.25, and that was in December 2022. Now, those are quite a few hikes that were taken then. And finally, they brought it up to about 5% in July 2023, and they've pretty much held it steady ever since. Now, you might be wondering, interesting, that's quite a bit of a leap, right? But we all know the story, what happened, because if you look at this picture here, or this graph, it actually tells a pretty interesting story. The line and the blue line is the policy rate percent, and the red line is inflation rate. So if you look at back in 2017, inflation was about 2% roughly, right? And the rate of interest by Bank of Canada was somewhere 0.5%. And then slowly by 2019, the inflation rate kind of went up, and so did the interest rates. But if you look at, 2020, COVID hit, inflation went absolutely down to 0% and a little bit even below. And by 2022, it touched 8%, and that was because Bank of Canada held steady the rate of interest at about very close to 0%. It was 0.25, I believe. So you can see what that did, right? Inflation just shot right up. And then by 2023, mid-23, Bank of Canada took the interest rate to about 5%. Now that's been the highest for a while. And then you can see how inflation kind of comes down, as the interest rate kind of goes up. So you can see it's a balancing game that Bank of Canada plays. It's tipping the scales and making sure it kind of demand and supply. That's what it is. But, you might be wondering what's going on here? How does Bank of Canada decide when to change the rates? How do they come to that conclusion? What needs to be done? What are the factors that are involved? Now, when we look at that, there's 5 things that you got to focus on. The first thing is oil prices. That's a base assumption that Bank of Canada made. Second was the exchange rate. Third was potential output growth. Fourth is the output gap. And finally, the fifth one was nominal neutral interest rate. Now, these 5 things, we'll discuss those moving forward. So let's start with oil prices. In oil price, it affects the economy in 4 ways. The first one is inflation. So here's the thing. Oil, it's used in many industries, right? Anywhere between transportation to keeping houses warm to chemicals and plastic industries, they all use oil. So if the price of oil goes up, the cost of all those things goes up. And that makes the inflation goes up as well, right? Now, the Bank of Canada, they tried to kind of keep the inflation between 2 to 3% range, somewhere there. But if anything that kind of goes higher than that, then they have to bring up the rates, right? To bring the inflation down. So that's one thing that oil does. Second, economic growth. Now, here's what happens. If the oil prices go up, people stop buying things because transportation gets expensive, services get expensive, goods become expensive because wherever oil is being used, the cost is going up. And the cost of creating things is slowly passed down to consumers like you and me. So we have to pay more. And because of that, the economy kind of stops growing. When that happens, if the economy is, slowing down, that's probably because inflation is going up, right? So if that's the case, Bank of Canada has to see what's going on there as well. They have to kind of maintain the scales. Third is exchange rate. Now, interestingly enough, Canada, they export a lot of oil, right? So they're one of the key exporters, right? So which means if the prices go up, the demand for Canadian dollars is going to go up as well, because whoever is buying oil, they have to buy that in Canadian dollars. So because of that, this can appreciate the Canadian dollar value. And once that is done, Canadian exports slowly become more expensive. So if your exports are becoming expensive, the demand kind of goes down, but whoever is selling, it's easier for them to like make a profit. But at the same time, other exporters, they heard from it. So Bank of Canada have to like kind of like, they have to decide what to do there as well. And finally, the government revenue. So this is interesting because, higher oil prices, they can bring in more government revenue from oil royalties. So, and this affects, the way the government's spending and fiscal policy is. And that policy from the government, it also impacts the policy from Bank of Canada to some extent. So that's something to keep in mind. Now, moving forward, if you look at, what Bank of Canada assumed in 2023 October about oil prices and what they're right now, there are some interesting things to kind of look at. So the assumption was that Brent crude would be at about $90 a barrel, but today a few days back, it was $74.30. It might be a little bit lower somewhere there. For West Texas Intermediate, they were expecting $85 a barrel, but the current price is about like $69.50. And for Western Canadian Select, they were expecting about $70 a barrel, but right now it's about like $47.32. So you're wondering like, okay, the oil rate is lower than expected, so how does it help? Well, good news is we don't have to spend that much on gas, so that's one good news, right? Now, here's another thing. Since the prices are coming down, it's dragging inflation lower a little bit as well, because it kind of helps consumers with disposable income, right? Second thing, economic growth. Now that people have a little bit more money to spend, the economic growth will actually kind of go up. But here's the catch. If the economy is growing, that means inflation, it'll also cause inflation to go up. So that's a little bit of like catch-22. You're like, okay, the cost has gone down, but it's also causing the economy to grow. So there's something Bank of Canada might have to consider about the interest rates. Third, exchange rate. Now, since oil is being exported and the oil prices are lower, the foreign buyers, they don't have to spend as much for the oil, right? Because they can buy more with less dollars. So this is basically making the Canadian dollar depreciate. So that impacts the export industries as well. So that's something Bank of Canada might have to look at, factor in for their decision. And finally, the government revenue, it's going to be a little bit lower as well because, well, the price of oil is lower, right? So that's going to impact the fiscal policies there as well as monetary. So that's kind of like just looking at oil. Moving forward, if you look at exchange rate, so you might be wondering like, okay, what is exchange rate? Exchange rate is basically one country's currency in terms of another country's. For example, one Canadian dollar is somewhere about like $62, 62 Indian rupees. So that's like, what exchange rate is. Now, here's the thing. If it's a strong dollar, you can expect cheaper imports for Canadians, lower inflation. Expensive exports that are going out, so it hurts exporters. If it's a weak dollar, the opposite happens. So that's kind of like, what exchange rate is. Now, if we talk about how exchange rate impacts the economy and the decision-making of Bank of Canada, again, 4 things. First is import-export prices. So a higher exchange rate, it'll make the exports to be a bit more expensive, but imports will be cheaper. That's just how it is, right? So if the imports are cheaper, people will be buying more and they'll be like, economy would kind of grow a bit more. That, again, something to kind of consider because if inflation goes up, what does that mean? Second, inflation itself. So exchange rate kind of like, it directly affects inflation. So for example, if Canadian dollar is weak, the cost of imported goods and services is going to, go up. Which can lead to higher inflation. So Bank of Canada wants to maintain that balance of 1 to 3%. So they have to adjust the interest rates again. And you see how inflation from exchange rate is directly kind of correlated with oil as well. So how things kind of are like, everything is kind of like, mixed and interlinked. And third is investment. So here's the thing. If the exchange rates are down, you can expect more foreign money coming into the economy, into Canadian economy. So investment goes up. So that'll actually help, to drive some business. Again, economic growth will change from there as well and potentially influence the decision for Bank of Canada. And finally, debt servicing. So for entities that have, borrowed in foreign currencies, a weaker domestic currency, so a weaker, their domestic currency means higher cost for that debt. This would impact financial stability. So these are like a few things that are affected directly by exchange rate. Now, when we look at the assumptions versus actual what's going on, Bank of Canada assumed a rate of about like about 74 cents USD for $1. And it's actually like in line with what they were expecting right now. That's where the dollar is, right? So you might be wondering, okay, so what happens if the dollar appreciates? Well, cheaper imports because, dollar is stronger. That means this could help Bank of Canada like lower the interest rates eventually, because it kind of like helps with the inflation. But at the same time, there's also like people who are exporting things. It'll hurt them. So the export industry will be hurt. So there's that balance to be maintained. So things to kind of keep in mind there. Now, moving forward, next is the potential output growth. Now, this is an interesting one, so I'm going to make it a bit more simpler for you to understand. Think of it like a speeding ticket, right? So potential output growth is like the speed limit of an economy. It's like the maximum speed that you should be going at. Now, if the fastest rate at which an economy is growing, that's more than the output growth, it's rising too much. That's not good, right? So imagine you're driving a car and the speed limit is like the fastest you can go without getting a ticket. Same way, if the economy is growing faster than this potential output growth, inflation will go up. That can hurt a lot of people, a lot of industries. So there's that. That happened in the past, right? So that's where we are now. But if an economy grows too fast and, it's the prices are going to go up too quickly and it'll be hard to catch up. So it's really important for Bank of Canada to see what the potential output growth is and where we are right now. So if you think about how does this impact the decisions, there are four things to kind of keep in mind with potential output growth here. First is your inflation pressure. So, if the maximum sustainable level of the amount that economy can grow by, it triggers an inflation that's going to hurt a lot of industries and a lot of people. It's happening right now. So Bank of Canada will actually raise the interest rates to slow down the economy. Now, second is output gap. Now, the output gap could be like the difference between what the GDP is expected to be and what it is. It could be negative, it could be positive. So depending upon where the economy is, again, Bank of Canada will decide what to do with the rates. Some other economic health indicators as well, that they look at before they make any changes to the interest rate. And finally, is just the policy effectiveness. Sometimes, understanding the potential output growth can help gauge Bank of Canada, how the policies are effective or not. So they might change their rates or, their policy depending on where the industry is and where it could be, right? So that's kind of something to keep in mind. Now, if we look at, what was expected and what it is, like assumptions and the real cases for potential output growth, something to keep in mind that, the Canadian economy, the growth has kind of stalled in the middle quarters of 2023. So the real GDP, it contracted by about 1.1% in the third quarter. So that's substantially lower. And there was a 1.4% growth in the second quarter. So there's a little bit of a disconnect there. And, the deviation, it's quite a bit because the potential output growth assumption was that back in 2022, the growth would be about 1.6% and to about 2% from year over year, right? So it's a little bit of a change there, a little bit of deviation. So that's a little concerning. Now, the contraction in GDP means the economy is slowing down. Unemployment rate is high. Jobs aren't coming up as much as they could. People aren't consuming or spending as much. So again, that's because the interest rates are so high right now. It's directly impacting that, right? So there's quite a bit of contraction opposed to what they were expecting. So, but then again, that's just what it would be, right? Now, let's look at output gap. To understand output gap, I know we spoke about it a little bit earlier, but I'm going to explain a little bit more. So it's basically, we'll look at the speed of the car versus speed limit analogy once again. So think about it like this. Now, output gap is the difference between how fast a car is actually going versus the speed limit. So it's the difference between the speed limit and what the car is doing. So if the economy is going faster than the potential output growth, the output gap would be positive. If it's going lower than that, it's negative. So depending upon the output gap, if it's positive or negative, the interest rates change, right? So that's kind of something to keep in mind. And this is what Bank of Canada thinks as well. Now, if we talk about the assumption versus what it is right now, the output gap. Now, Bank of Canada was estimating the output gap to be anywhere between minus 0.75% to about 0.25%, in the third quarter of 2023. Now, that suggests that economy is approaching balance because earlier there was way too much demand and there wasn't enough supply. So there was quite a bit of output gap there. Now the labor market is slowing down. There aren't as many jobs coming up, and unemployment rate is slowly inching up. It's at about 5.8% right now. So that's quite a bit increase from what it was earlier in the year. But there's still some signs of excess demand because if you look at the housing cost, it's still growing because mortgages went up. And then also some of the businesses are still charging quite a bit for the services. So the wage growth there has to kind of slow down a little bit as well. So it's just a few things that, Bank of Canada is considering. So that's kind of good to know because you can gauge what might be the case in the coming few months. Now, let's quickly look at nominal neutral interest rate. That's the final factor. Now, in simple terms, it's basically the interest rate that would prevail in the economy when it's operating at full capacity and inflation is stable. So imagine inflation was about 2 to 3% and economy was doing the best it can. That is what, the nominal neutral interest rate is. And this is set by Bank of Canada. It's generally considered to be, tight monetary policy if they are increasing the interest rate. And if the interest rate is lower than the nominal neutral interest rate, it's a little bit of a loose policy. So depends upon where the inflation is, depends upon where the economy is, right? So that's what Bank of Canada considers when they're making those decisions. So now to kind of bring it all home together, you might be wondering, okay, good. You told me about everything. So how does that impact us in the next few quarters? So first thing first, now when we wrap up this entire, factors, the inflation outlook by Bank of Canada, they're keeping a close eye on both the upside and the downside. If the inflation is too low, then they'll have to cut the rates again, bring economy, have some economic growth again. And if it's still not low enough, the inflation rate, they will have to hold the interest rates. So it's kind of finding the right tipping balance. I believe, and this is a lot of economic experts, what they are saying is that, we could see some rate cuts by August, September next year. And honestly, I think that would make sense because right now there's still some excess demand about how businesses are operating and what the housing is doing. But then again, the housing is just another disaster here in Canada. So that's a whole different story that we have to talk about later on. So from the looks of it, from what the assumptions are, and how a lot of these things impact the policies, I think maybe by September next year we should see some reprieve from Bank of Canada. But until then, interest rates are going to be where they are right now. And again, exchange rate, the dollar is pretty steady right now. So let's see what happens in the coming few months. And of course, the output growth, it's changing a little bit from what they were assuming. Economy is slowing down, so things might start to look to improve in the next 2 quarters. So hang tight. Things are tough, but hey, you know what? We'll make through. We always have. So that's something we got to consider. And also, if you have any questions, drop them in the comments. We'll have a look at there. And if you need any help with anything, give me a shout out. Well, I hope you enjoyed the video, and I guess I'll see you in the next one. Take care.